Welcome to our lecture series in financial technical analysis. Today, we will talk about average directional index. Let's begin. The average directional index is a crucial technical analysis indicator introduced by J. Wells Wilder in 1978. It measures trend strength regardless of direction, utilizing the positive directional indicator, positive DI, and negative directional indicator, negative DI, to assess market trends. Average directional index values above 25 typically indicate a trending market, while values above 50 suggest a very strong trend. Wilder's original formula uses high, low, and close prices to compute true range and directional movement. When only closing prices are available, a close-only approximation can be used for teaching and intuition. The relative moving average is used for smoothing. It places greater emphasis on recent prices, similar to an exponential moving average, but uses a distinct smoothing mechanism that combines the previous relative moving average value with the current price to produce a weighted average. The positive and negative directional indicators, positive DI and negative DI, are then calculated by dividing the smoothed directional movement by the smoothed true range, multiplied by 100. The Directional Movement Index, DX, quantifies the difference between positive DI and negative DI relative to their sum. Finally, Average Directional Index is calculated as the smoothed relative moving average of directional index, typically over 14 periods using Wilder's smoothing method. This image displays SPI daily prices over 150 days, with the top panel showing price and the lower panel illustrating positive DI, negative DI, and average directional index. Notice how the positive DI and negative DI lines fluctuate, indicating bullish or bearish bias, and how the average directional index line crosses above 25 during strong trends. A rising average directional index, especially from below 20 up through 25, signals a strengthening trend. If positive DI is above negative DI, it suggests bullish pressure, while negative DI above positive DI indicates bearish pressure. Average directional index also acts as a regime filter, helping traders decide when to deploy momentum versus contrarian tactics. In behavioral finance, a rising average directional index can reinforce price persistence as many participants condition entries on strengthening trends. Conversely, when average directional index falls, traders anticipate mean reversion, dampening trends, connecting average directional index to crowd psychology. One of the strengths for average directional index is its clear measure of trend strength, making it useful as a regime filter. It complements price patterns and moving averages and is adaptable across various assets and timeframes. However, average directional index can lag by construction, meaning strong moves may be partly over by the time average directional index confirms. The close-only approximation loses detail compared to the OHLC-based Wilder method. An average directional index can remain elevated during late trend chop, risking whipsaws. To apply average directional index, one exercise involves computing average directional index using both close-only and full Wilder OHLC methods to compare signals. Another exercise is to identify periods where average directional index crosses 25 from below and describe how to size a momentum trade. When average directional index declines from above 30 to below 20, outlining a contrarian strategy with risk controls is a valuable exercise. Finally, combining average directional index with indicators like RSI or Bollinger Bands can help design a composite regime switching rule. Understanding average directional index provides a robust tool for identifying trend strength and making informed trading decisions. Thank you for watching our lecture in Financial Technical Analysis focusing on average directional index. See you at the next lecture.